Algorithmic trading, also called algo trading and blackbox trading, encompasses trading systems that are heavily reliant on complex mathematical formulas and high-speed computer programs to determine trading strategies. These strategies use electronic platforms to enter trading orders with an algorithm which executes pre-programmed trading instructions accounting for a variety of variables such as timing, price, and volume. Algorithmic trading is widely used by investment banks, pension funds, mutual funds, and other buy-side institutional traders to divide large trades into several smaller trades to manage market impact and risk. Algorithmic trading may be used in any investment strategy or trading strategy, including market making, intermarket spreading, arbitrage, or pure speculation. The investment decision and implementation may be augmented at any stage with algorithmic support or may operate completely automatically. Many types of algorithmic or automated trading activities are often described as high-frequency trading, which is a specialized form of algorithmic trading characterized by high turnover and high order-to-trade ratios. As a result, in February 2012, the Commodity Futures Trading Commission formed a special working group that included academics and industry experts to advise the CFTC on how best to define HFT. HFT strategies utilize computers that make elaborate decisions to initiate orders based on information that is received electronically, before human traders are capable of processing the information they observe. Algorithmic trading and HFT have resulted in a dramatic change of the market microstructure, particularly in the way liquidity is provided. Emblematic examples: profitability projections by the TAB Group, a financial services industry research firm, for the U.S. equities HFT industry were $1.3 billion before expenses for 2014, significantly down on the maximum of $21 billion that the 300 securities firms and hedge funds that then specialized in this type of trading took in profits in 2008. Which the authors had then called a relatively small, and surprisingly modest, when compared to the market's overall trading volume. In March 2014, Virtu Financial, a high-frequency trading firm, reported that during 5 years the firm as a whole was profitable on 1,277 out of 1,278 trading days, losing money just one day, empirically demonstrating the law of large numbers benefit of trading thousands to millions of tiny, low-risk and low-edge trades every trading day. A third of all European Union and United States stock trades in 2006 were driven by automatic programs, or algorithms. As of 2009, studies suggested HFT firms accounted for 60 to 73% of all U.S. equity trading volume, with that number falling to approximately 50% in 2012. In 2006, at the London Stock Exchange, over 40% of all orders were entered by algorithmic traders, with 60% predicted for 2007. American markets and European markets generally have a higher proportion of algorithmic trades than other markets, and estimates for 2008 range as high as an 80% proportion in some markets. Foreign exchange markets also have active algorithmic trading. Futures markets are considered fairly easy to integrate into algorithmic trading, with about 20% of options volume expected to be computer-generated by 2010. Bond markets are moving toward more access to algorithmic traders. Algorithmic trading and HFT have been the subject of much public debate since the U.S. Securities and Exchange Commission and the Commodity Futures Trading Commission said in reports that an algorithmic trade entered by a mutual fund company triggered a wave of selling that led to the 2010 flash crash. The same reports found HFT strategies may have contributed to subsequent volatility by rapidly pulling liquidity from the market. As a result of these events, the Dow Jones Industrial Average suffered its second-largest intraday point swing ever to that date, though prices quickly recovered. A July 2011 report by the International Organization of Securities Commissions, an international body of securities regulators, concluded that while algorithms and HFT technology have been used by market participants to manage their trading and risk, their usage was also clearly a contributing factor in the flash crash event of May 6, 2010. However, other researchers have reached a different conclusion. One 2010 study found that HFT did not significantly alter trading inventory during the flash crash. Some algorithmic trading ahead of index fund rebalancing transfers profits from investors. History. Computerization of the order flow in financial markets began in the early 1970s, with some landmarks being the introduction of the New York Stock Exchange's designated order turnaround system, which routed orders electronically to the proper trading post which executed them manually. The opening automated reporting system aided the specialist in determining the market clearing opening price. Program trading is defined by the New York Stock Exchange as in order to buy or sell 15 or more stocks valued at over $1 million total. In practice, this means that all program trades are entered with the aid of a computer. In the 1980s, program trading became widely used in trading between the S&P 500 equity and futures markets. In stock index arbitrage, a trader buys a stock index futures contract such as the S&P 500 futures and sells a portfolio of up to 500 stocks at the NYSE matched against the futures trade. The program trade at the NYSE would be pre-programmed into a computer to enter the order automatically into the NYSE's electronic order routing system at a time when the futures price and the stock index were far enough apart to make a profit. At about the same time, portfolio insurance was designed to create a synthetic put option on a stock portfolio by dynamically trading stock index futures according to a computer model based on the Black-Scholes option pricing model. Both strategies, often simply lumped together as program trading, were blamed by many people for exacerbating or even starting the 1987 stock market crash. Yet the impact of computer-driven trading on stock market crashes is unclear and widely discussed in the academic community. Financial markets with fully electronic execution and similar electronic communication networks developed in the late 1980s and 1990s. In the U.S., decimalization, which changed the minimum tick size from 1/16 of a dollar to 1 cent per share, may have encouraged algorithmic trading as it changed the market microstructure by permitting smaller differences between the bid and offer prices, decreasing the market maker's trading advantage, thus increasing market liquidity. This increased market liquidity led to institutional traders splitting up orders according to computer algorithms so they could execute orders at a better average price. These average price benchmarks are measured and calculated by computers by applying the time-weighted average price, or more usually by the volume-weighted average price. It is over. The trading that existed down the centuries has died. We have an electronic market today. It is the present. It is the future. Robert Griefeld, Nasdaq CEO. April 2011. A further encouragement for the adoption of algorithmic trading in the financial markets came in 2001 when a team of IBM researchers published a paper at the International Joint Conference on Artificial Intelligence where they showed that in experimental laboratory versions of the electronic auctions used in the financial markets, two algorithmic strategies could consistently outperform human traders. MGD was a modified version of the GD algorithm invented by Stephen Kierstad and John Dickhout in 1996. The ZIP algorithm had been invented at HP by Dave Cliff in 1996. In the paper, the IBM team wrote that the financial impact of their results showing MGD and Zip outperforming human traders might be measured in billions of dollars annually. The IBM paper generated international media coverage. As more electronic markets opened, other algorithmic trading strategies were introduced. These strategies are more easily implemented by computers, because machines can react more rapidly to temporary mispricing and examine prices from several markets simultaneously. For example, chameleon, stealth, sniper and guerrilla arbitrage, statistical arbitrage, trend following, and mean reversion. This type of trading is what is driving the new demand for low-latency proximity hosting and global exchange connectivity. It is imperative to understand what latency is when putting together a strategy for electronic trading. Latency refers to the delay between the transmission of information from a source and the reception of the information at a destination. Latency has as a lower bound determined by the speed of light. This corresponds to about 3.3 milliseconds per 1,000 kilometers of optical fiber. Any signal regenerating or routing equipment introduces greater latency than this light speed baseline. Strategies: trading ahead of index fund rebalancing. Most retirement savings, such as private pension funds or 401 and individual retirement accounts in the U.S., are invested in mutual funds, the most popular of which are index funds, which must periodically rebalance or adjust their portfolio to match the new prices and market capitalization of the underlying securities in the stock or other index that they track. Profits are transferred from investors to algorithmic traders, estimated to be at least 21 to 28 basis points annually for S&P 500 index funds, and at least 38 to 77 basis points per year for Russell 2000 funds. John Montgomery of Bridgeway Capital Management says that the resulting poor investor returns from trading ahead of mutual funds is the elephant in the room that, shockingly, people are not talking about. Pairs trading or pair trading is a long-short, ideally market-neutral strategy enabling traders to profit from transient discrepancies in relative value of close substitutes. Unlike in the case of classic arbitrage, in case of pairs trading, the law of one price cannot guarantee convergence of prices. This is especially true when the strategy is applied to individual stocks. These imperfect substitutes can in fact diverge indefinitely. In theory, the long-short nature of the strategy should make it work regardless of the stock market direction. In practice, execution risk, persistent and large divergences, as well as a decline in volatility can make this strategy unprofitable for long periods of time. It belongs to wider categories of statistical arbitrage, convergence trading, and relative value strategies. Delta-neutral strategies in finance. Delta-neutral describes a portfolio of related financial securities, in which the portfolio value remains unchanged due to small changes in the value of the underlying security. Such a portfolio typically contains options and their corresponding underlying securities such that positive and negative delta components offset, resulting in the portfolio's value being relatively insensitive to changes in the value of the underlying security. Arbitrage in economics and finance. Arbitrage, RBTR, is the practice of taking advantage of a price difference between two or more markets, striking a combination of matching deals that capitalize upon the imbalance, the profit being the difference between the market prices. When used by academics, an arbitrage is a transaction that involves no negative cash flow at any probabilistic or temporal state and a positive cash flow in at least one state. In simple terms, it is the possibility of a risk-free profit at zero cost. Example: one of the most popular arbitrage trading opportunities is played with the S&P futures and the S&P 500 stocks. During most trading days, these two will develop disparity in the pricing between the two of them. This happens when the price of the stocks which are mostly traded on the NYSE and Nasdaq markets either get ahead or behind the S&P futures which are traded in the CME market. Conditions for arbitrage. Arbitrage is possible when one of three conditions is met. The same asset does not trade at the same price on all markets. Two assets with identical cash flows do not trade at the same price. An asset with a known price in the future does not today trade at its future price discounted at the risk-free interest rate. Arbitrage is not simply the act of buying a product in one market and selling it in another for a higher price at some later time. The long and short transactions should ideally occur simultaneously to minimize the exposure to market risk, or the risk that prices may change on one market before both transactions are complete. In practical terms, this is generally only possible with securities and financial products which can be traded electronically, and even then, when first leg of the trade is executed, the prices in the other legs may have worsened, locking in a guaranteed loss. Missing one of the legs of the trade is called execution risk, or more specifically, leg-in and leg-out risk. In the simplest example, any good sold in one market should sell for the same price in another. Traders may, for example, find that the price of wheat is lower in agricultural regions than in cities, purchase the good, and transport it to another region to sell at a higher price. This type of price arbitrage is the most common, but this simple example ignores the cost of transport, storage, risk, and other factors. True arbitrage requires that there be no market risk involved. Where securities are traded on more than one exchange, arbitrage occurs by simultaneously buying in one and selling on the other. Such simultaneous execution, if perfect substitutes are involved, minimizes capital requirements, but in practice never creates a self-financing position, as many sources incorrectly assume following the theory. As long as there is some difference in the market value and riskiness of the two legs, capital would have to be put up in order to carry the long-short arbitrage position. Mean reversion. Mean reversion is a mathematical methodology sometimes used for stock investing, but it can be applied to other processes. In general terms, the idea is that both a stock's high and low prices are temporary, and that a stock's price tends to have an average price over time. An example of a mean reverting process is the Ornstein-Uhlenbeck stochastic equation. Mean reversion involves first identifying the trading range for a stock, and then computing the average price using analytical techniques as it relates to assets, earnings, etc. When the current market price is less than the average price, the stock is considered attractive for purchase, with the expectation that the price will rise. When the current market price is above the average price, the market price is expected to fall. In other words, deviations from the average price are expected to revert to the average. The standard deviation of the most recent prices is often used as a buy or sell indicator. Stock reporting services commonly offer moving averages for periods such as 50 and 100 days. While reporting services provide the averages, identifying the high and low prices for the study period is still necessary. Scalping. Scalping is liquidity provision by non-traditional market makers, whereby traders attempt to earn the bid-ask spread. This procedure allows for profit for so long as price moves are less than this spread and normally involves establishing and liquidating a position quickly, usually within minutes or less. A market maker is basically a specialized scalper. The volume a market maker trades is many times more than the average individual scalper, and would make use of more sophisticated trading systems and technology. However, registered market makers are bound by exchange rules stipulating their minimum quote obligations. For instance, Nasdaq requires each market maker to post at least one bid and one ask at some price level, so as to maintain a two-sided market for each stock represented. Transaction cost reduction. Most strategies referred to as algorithmic trading fall into the cost reduction category. The basic idea is to break down a large order into small orders and place them in the market over time. The choice of algorithm depends on various factors, with the most important being volatility and liquidity of the stock. For example, for a highly liquid stock, matching a certain percentage of the overall orders of stock is usually a good strategy. But for a highly illiquid stock, algorithms try to match every order that has a favorable price. The success of these strategies is usually measured by comparing the average price at which the entire order was executed with the average price achieved through a benchmark execution for the same duration. Usually, the volume-weighted average price is used as the benchmark. At times, the execution price is also compared with the price of the instrument at the time of placing the order. A special class of these algorithms attempts to detect algorithmic or iceberg orders on the other side. These algorithms are called sniffing algorithms. A typical example is stealth. Some examples of algorithms are TWAP, VWAP, implementation shortfall, POV, display size, liquidity seeker, and stealth. Modern algorithms are often optimally constructed via either static or dynamic programming. Strategies that only pertain to dark pools. Recently, HFD, which comprises a broad set of buy-side as well as market-making sell-side traders, has become more prominent and controversial. These algorithms or techniques are commonly given names such as stealth, iceberg, dagger, guerrilla, sniper, BASOR, and sniffer. Dark pools are alternative trading systems that are private in nature, and thus do not interact with public order flow, and seek instead to provide undisplayed liquidity to large blocks of securities. In dark pools, trading takes place anonymously, with most orders hidden or iceberged. Gamers or sharks sniff out large orders by pinging small market orders to buy and sell. When several smaller orders are filled, the sharks may have discovered the presence of a large iceberged order. Now it's an arms race, said Andrew Lowe, director of the Massachusetts Institute of Technology's Laboratory for Financial Engineering.